Hi, this is CS Jata. In today's Crack the Code series, we are going to understand the applicability of income tax for resident welfare associations. When I say income tax, it can be broadly, analyzed from two angles. One is the applicability of income tax with respect to the provisions, in the sense, what is the tax rate? What are the types of income? How is it being taxed? And second, with respect to the procedural aspects, say what are the compliances, in the sense what kind of returns are to be filed, how it has to be filed, and what are the consequences that arises out of non-compliance with respect to the income tax. So in the next 15 to 20 minutes, I'll take you through the complete provisions of income tax that are relevant for resident welfare associations. Majority of resident welfare associations in any states, it is registered as a AOP, that is Association of Persons, or it is registered as a society. When I say it is AOP, which falls under the definition of section 231(5) of the Income Tax Act, which defines a person. And when I say income, the income tax imposes income in respect of the income earned in the previous year for any person. It means that whatever income earned by the association of persons is liable for income tax. But having said this, there is something called as constitutional provision called doctrine of mutuality, which says that any person should not make profit out of himself. No person should make profit out of himself, in the sense the association consists of members, and RWA and the members are considered as one and the same. It means that as far as RWA is concerned, it is an association of persons joined together for a common purpose without any profit motive. Hence, it is not treated as two different persons in the income tax angle, because of which the doctrine of mutuality is applicable, in the sense any income earned from members is not liable for income tax. So it falls apart from the definition of income as defined under section 224. So when I say the income, whether all the incomes from members are taxable or not taxable, this is something very controversial, because the courts or the department has held differently for different cases. So let us have a very conservative approach that the income earned from the maintenance charges, we call it as CAM charges, are not liable for income tax, and other incomes earned by members or other incomes, in the sense from income earned from non-members and the interest on fixed deposits, are liable for tax. So when I say exempted income and taxable income and other income, I have just listed down here in this slide that the CAM charges are called as exempted income, and other income, if depending on your risk appetite, the resident welfare associations takes a call whether, interest on delayed payment of maintenance, move in and move out charges, and car parking charges that it collects from its members on a monthly basis, or whenever there is a transfer, second sale happens from one resident to the other person, the association collects certain fee. Whether it is liable for tax or not is left to the risk appetite of the RWAs. But if you want to be more conservative, you can offer it for tax, or if you strictly want to follow the principle of mutuality, the other incomes can also be considered as exempted income. When I say taxable income, apart from these set of incomes, the association receives certain other income in the name of advertisement charges. It comes from external third party, or from their own residents, like from the members, and notice board for a short period of time. Depending on the number of days the notice board is put up, their advertisement is put up on the notice board, the association charges certain fees. So that income is also liable for income tax. And rental income. Sometimes the associations, give their property clubhouse to any retail outlet or any kind of pharmacy or ATMs. So those rental incomes are also liable for income tax under the head income from house property, depending on the nature of the building or stall that it has let it out. And also in many of the occasions, whenever the Resident Welfare Association organizes a function, internal functions for celebration of any festivals, it collects certain sponsorship fee from sponsors. So that will also come under the other income. When I say other income from others, apart from these two income, there are certain other income called interest on FD, because whatever surplus the association generates out of its maintenance collection or out of its own funds, or from the income it has generated from non-member incomes, certain portion is parked in fixed deposits or it is kept in the bank account. So it receives income in the form of interest on FD, interest on savings bank. Sometimes it is kept invested in the mutual funds. So the whatever dividend income it earns is also treated as other income and liable for tax at the respective rates. So when I say respective rates, we have to understand what is the applicable rate of tax for resident welfare associations. So section 167B states that for resident welfare associations, where basically for AOPs, where the share of the individual members is indeterminate, it is taxable at MMR, that is maximum marginal rate, which is usually at 30%. Whereas with effect from 1st of April 2024 by the Finance Act 2023, as per section 115 BAC, subclause 1A, which states that as per the new scheme, there is a specific inclusion of association of person also. Earlier, it was only individuals or HUF. From the current year, it has been, AOP has also been included in that subclause, through which the association of persons, that is the resident welfare associations, can also avail the benefit. It is a very welcoming provision by inclusion of AOP also into section 115 BAC, through which the association is eligible enough to offer the income tax on other income, namely the income earned from its members, income earned from non-members, and the interest income under the slab rate. So as per the Finance Act, say for example, for the financial year 2024-25, up to 3 lakhs it is taxed. There is no tax. From 3 to 6 lakhs it is taxed at 5%. From 3 lakhs to 9 lakhs it is taxed at 10%. 9 lakhs to 12 lakhs it is charged at 15%. 12 to 15 lakhs it is charged at 20%. Over and above 15 lakhs it is charged at 30%. Over and above that, depending on the gross total income, when it exceeds 50 lakhs, then there is no less than 50 lakhs, of course, there is no surcharge. When it exceeds 50 lakhs to 1 crore, up to 1 crore, the surcharge is taxed at 10%. 1 to 2 crores, 15%. 2 crores to 5 crores is 25%. And any gross total income of more than 5 crore, it is taxed at the highest slab of 37% of surcharge. Over and above the surcharge, there is education cess, health and education cess, which is charged at 4%, irrespective of whether applicability of surcharge is there or not. So it is preferable for the association to go with the 115 BAC so that they are eligible enough to get their incomes taxed at the slab rate instead of the maximum marginal rate, which is at 30%. So when I say computation of income, this is the illustration which is given to you. We know that maintenance income is exempted from income tax. So basically, whatever gross receipts less the expenses relating to the upkeep of the apartment can be claimed as a deduction. The surplus, what it gets from that activity, is purely exempted. Can be a surplus or it can be a deficit. Of course, deficit cannot be carried forward. The surplus also need not be taxed. It is exempted under the concept of mutuality. So when I say income from other sources, there are two types of income. Member income. Member income others, say car parking charges or notice board charges, whatever it collects, party hall charges, whatever it collects from its members, and the non-members, say stall rental, sponsorship fee, this income is taxed under income from other source. Any expenses incurred for earning this income, any expenses incurred for earning this income can also be claimed as a deduction. If as a conservative approach, it is left to the association. If they do not want to claim any expenditure, they don't have to. But strictly speaking, if they want to claim that expenses which are directly relatable, identifiable for earning that income, definitely some portion of it on a reasonable basis, it can be claimed as a deduction, so that only the net or the surplus only is offered for income tax. Over and above that, there is interest income, dividend income, those are all fully taxed. So there is no need for claiming any deduction under those heads of income. So when I say tax rate, as I mentioned earlier, it can be taxed at a slab rate or at a maximum marginal rate. When it comes to filing of returns, the Resident Welfare Association is liable for filing income tax returns within the due date as specified under section 139(1) on or before 31st of July of every year. So the return that needs to be filled is ITR 5. And whenever there is an income crossing certain prescribed limit, say 1 crore, 5 crore, or 10 crore, the first question comes into the minds of any RWA is that, is it liable for tax audit? The answer to this question is no. 44AB is not applicable for Resident Welfare Association because of the simple reason that the association is not carrying out any activity relating to business or profession. This is basically the collection of funds from its own members. It is pooled and used for the mutual benefit of its own members. So that's the reason why under the concept of mutuality, the surplus that is generated out of the collection of funds has been given as an exemption. Because there is no business activity, the provisions of 44AB is not applicable. So at the time of filing ITR 5, the RWA needs to fill up the P&L account, P&L schedule, balance sheet schedule, claiming the surplus as exempted income. And whenever there is a deficit, it need not be carried forward. And there are certain associations, there are few associations where they choose not to fill up the P&L and balance sheet schedule. Of course, balance sheet also to be filled. Balance sheet schedule also in the ITR 5 needs to be filled. And the depreciation schedule also needs to be filled so that it matches with the P&L depreciation claimed as per the Income Tax Act. Then when it comes to the reporting with respect to the income from non-members, it needs to be filled up in the appropriate schedules, income from other source, or whenever there is a rental income, say clubhouse is given for a rental, one portion of clubhouse is given for rental to any pharmacy or supermarket, then the rental income received out of those places needs to be reported under income from house property. And any capital gains on sale of mutual funds or any other debt funds needs to be reported at the appropriate head, and appropriate taxes are to be paid as a long-term capital gain tax or short-term capital gain tax, depending on the transactions. And when it comes to the declaration part, the last part of the ITR 5, this needs to be reported or declared by the authorized person, basically who's the treasurer or the secretary or president of the Resident Welfare Association, who's liable for correct filling of forms and filing of returns and disclosure of all incomes that the association has earned during the period. So he's the person responsible, and he declares that whatever reported is true and correct, and it has to be e-verified or it can be digitally signed. So this is what is all about filing process is concerned. When I say the income tax other provisions, of course, TDS is also applicable. The provisions relating to TDS is applicable. Section 194J for professional fee, wherever there is an professional fee exceeding 30,000, 194J is applicable. And if the association has any employees, full-time employees, then the provisions of section 192 B is applicable, 192 is applicable, and whenever there is payment to contractors or security charges, facility management charges, so contractors payments are liable for 194C. And after deduction of TDS, the RWA is required to file on a monthly, remit the monthly deduction of TDS on or before 7th of the subsequent month. And TDS returns are to be filed on a quarterly basis before 31st of July or 31st of October. As per the TDS rules, the returns are to be filed. So any consequences, any non-filing consequences which are applicable to any other assessees is applicable for RWA also. It means that failure to file income tax returns, say the due date is 31st of July, if it is not filed within so-and-so due date, then the applicable 234F, either 1,000 rupees or 5,000 rupees is very much applicable for RWAs also. And since that RWAs are liable for income tax, the advance tax also needs to be calculated on a quarterly basis, and it has to be installments are to be discharged on a timely manner. So any non-compliance liable for interest under 234 ABC. And when it comes to TDS non-remittance or delayed remittance of TDS attracts 2011A and 271C, that is penalty for failure to deduct TDS. So the provisions relating to TDS and income tax under Income Tax Act is viewed very seriously, irrespective of the assessees or association of person or individual or company. The provisions are the same. So with this, I have come to the last part of the presentation. If you have any doubts relating to income tax on RWAs, you can always reach out to me. Thank you.